Good afternoon, everyone. I am Chelsea Wee, your host for this final session. Our final session for today features Mr. Cheng Tian, a quant trader from Tokka Labs. Mr. Cheng will discuss quant trader on decentralized exchanges, providing an in-depth look into the world of quantitative trading and its applications in decentralized finance. Mr. Cheng is a seasoned quant trader and research strategist at Tokka Labs. With a proven track record in algorithmic trading, Mr. Cheng also spearheads the research division, driving innovation and shaping the firm's strategic approach to decentralized financial markets. Tokka Labs specializes in blockchain technology and decentralized finance, or DeFi, innovations. They focus on creating cutting-edge solutions that push the boundaries of blockchain applications, aiming to transform how businesses and individuals interact with the digital economy. Mr. Chung, please.
Okay, thanks. Can you hear me?
Yep, we can hear you.
Can you let me share my screen?
Yep, so you're currently co-host. Maybe Andrew stop sharing. Yeah.
Okay. Let me see. Am I sharing my screen correctly?
Yep, we can see your screen. However, you're on presenter view. Maybe you can, use the other kind of presentation view.
Okay, how do I change?
So I believe that should be on the slideshow, I believe. No, that's the presenter view.
Okay, let me do it again. Sorry.
Yep, looks good.
Yeah, cool. Okay, yeah, thanks host, and good afternoon, everyone. My name is Chen, and I'm from Tokka Lab. Yeah, it's quite an honor here to give this workshop about the quant trading on decentralized exchange to share some of my view and my thoughts. To start with, we are Tokka Labs. Tokka Lab is a priority prop trading firm based in Singapore with a focus on close collaboration, rigorous research, and cutting-edge technology. We are market makers for top exchanges and DeFi protocols on the most popular blockchains in the world. So, and as for today, I'm going to share more about the DEX, trading on DEX and DeFi. So to start with, we need to first understand what is DeFi. DeFi is short for decentralized finance. It is an umbrella term for financial services on public blockchains. So the idea of DeFi actually relative to the centralized finance, or so-called the traditional finance, in which centralized entities are providing different kind of the finance services for us. So for example, in bank, we can borrow and lend money. In exchange, we can do the swap of assets or even trade derivatives. And in interest company, we can buy interest to protect our financial assets. And in funds, we can make our investment in different kind of sector without worrying about the strategies behind it. So these are all the TradFi's entities providing the financial services. But on DeFi, there are no such kind of the centralized entities. Instead, different kind of the protocols build their own DApps on with smart contract on blockchain to provide different kind of services mentioned as in traditional finance. For example, in A protocol, you can borrow and lend crypto assets. In Lido protocol, you can staking your tokens and getting reward from it. So sounds like similar to the deposit your cash into a bank to get the interest. And with Uniswap, the decentralized exchange, you can swap your crypto assets with others. And with Nexus, you can buy the insurance for your crypto asset as well. So this is how the DeFi's are working nowadays. There are a lot of protocols are developing, and some largest names has already have the billions of TVL. So due to time constraint, I will not elaborate more about the protocols, but if you are interested, you can check the DeFi Llamas link here to see more. And today, we'll focus on more about the decentralized exchange. So as the definition from Coinbase, a decentralized exchange is a peer-to-peer marketplace where transactions occur directly between crypto traders. So it sounds very simple, but actually requires a big change in the trust layer of the swap. In real life or in traditional finance trading, we trade on exchange or bank because we believe those big names. So basically, if I want to trade some assets with maybe you as another trader, I believe the exchange, so I put my money in the exchange, and you also believe in the exchange, so you do the same thing. Then the exchange help us swap the assets and give it back to us. That's also because we believe the exchange and their reputations. But even with the big names reputation, there is still counterparty risks. We do see big names falls in the financial crisis. Now imagine the case there is no such a big name third party. How do we actually do the swap? Especially when both of us are anonymous, or we are just like a wallet address. So how do we trust each other? So if I send my money to your wallet, you don't send me back, then I actually have nothing to do with that. So the solution the DEX offer is that instead of we trust each other's reputation, we trust on the smart contract and the characteristics of blockchain that is unreversible. So which means now, because I trust the smart contract, I will send my token to a smart contract, and you will also send your token to the smart contract. Then the smart contract will settle the swap and back the things correspondingly. If you didn't sign the contract from your side, then both leg will fail. So there's no worry about single side fail issue as mentioned above. So that's how the DEX solve the trust issues. So the idea of the decentralized exchange is also relative to the centralized exchange as well. Not only from the TradFi, the exchange also in crypto world, there are also centralized exchanges here. So now let's say we are a retail user, we want to get exposure to the crypto world, we want to buy some cryptos and trade ourselves. We actually have two ways. First is we go to some big centralized exchange like Binance, and we do the KYC and create our own account. Then we can top up our fiat and buy the cryptos in the exchange itself. The other way is that we can go to some online app such as MetaMask to create our own crypto wallet. Then we hold our own private key, and then we can do some OTC trading or transfer from other wallet address to start trading on DeFi. So nowadays, actually, these two kinds of the method are linked already. So which means you can transfer your funds in SEX to your DEX wallet or vice versa. And here's a quick comparison of the DEX and SEX. So on DEX, the funds are self-custodian and the private key is held by yourself, so it's self-responsible. It can be both a good thing and bad thing. Good thing that no one else can touch your funds. Bad thing that if you lose your private key or you're wrongly sent to a wrong address, then you're losing your fund. So but on centralized exchange, your funds are third-party custodian, while if you facing some issue, you can get the exchange services to help, which is more user-friendly. And also on DEX, there's a wide range of token pairs you can trade on, because on DEX, when a new token is launched, it's very easy to create a pool to start trading. While on centralized exchanges, because all the token listed are going to be reviewed by the exchange themselves. So it takes a longer time, and some token may not be able to be listed. So the trading pairs are limited there. And also on DEX, because everything is settled on chain, so especially on Ethereum mainnet nowadays, the block time is every like 12 seconds, so which means you can only get your transaction update or swap update after 12 seconds. So, and also because the ETH price is rising now, the transaction fee can be relatively high. While if you trade on centralized exchange, because every data is hosted by the exchange itself, so it can be fast and relatively cheap now. And last but not least, the DEX, everyone is anonymous, so you're just a wallet address, unless you release your wallet address yourself to mark yourself as some entity. Otherwise, it's all anonymous. While on centralized exchange, every customer will do the KYC. So these are the major difference between the DEX and SEX. And now, since we have solved the problem of the trust layer, how do we actually match our trade intent on DEX? So at very beginning, intuitively, some protocols trying to bring the exchange order book system on chain, but that fails because the reason same as we mentioned above, the gas fee is high and also the block time is quite long, it's slow. So we cannot actually bring all the matching engine on chain. And therefore, there are some compromise or so-called hybrid solution come out, which means when user trades through their exchanges, the matching are actually offline while the settlement of the token is on chain. But that is not fully a DEX setting, so we'll not discuss more for today. And other solutions are the automated market maker, so-called AMM, and the Perpetual DEX, and the PMM and aggregator model. We will go one by one in the following time. So first is the AMM model, so-called automated market maker. The one representable protocol is called the Uniswap. Uniswap is currently the largest DEX, contribute about larger than 50% of the overall volume in DEX nowadays, and is well known for the famous X time Y equals K, the constant product formula. This is how they are going to determine the swap price and match the intent of both side traders, which we'll go through details in the later slides. And in the AMM model, there are no like maker and taker as in the order book system. Instead, makers are called liquidity provider who provide two tokens to create a pool, and trader instead of trade against the maker directly, they trade against the pool. So basically, they trade against all the makers inside the pool with their ratio correspondingly. So here's a simple example how the pools are created and how the liquidity provider and trader interact with the pool. So here is a pool created by Uniswap and with token A and token B. Now the reserves in the pool is there are 100 token A in the pool and there are 10 token B in the pool. So the price of token A over B is just 100 over time, which is 1 token B equals 10 token A. So that's how the price are discovered. So when the new liquidity provider want to join the pool, he need to deposit his fund into the pool. So let's say he deposit 10 token A and 1 token B in the pool. It must be the same ratio as the pool reserve. Then he will be given some LP shares or LP tokens to prove that he hold the shares of the pool. Then if a trader come in, he can swap against the pool with a price inside the pool. So basically, if he input 10 token A plus the 30 bips fee, he can output 1 tokens of token B. That is how the traders trade against the pool. Then take a closer look at how the price are discovered. After the trader swap let's say inside pool now there are like 1.2K of token A and 400 of token B, and the price of token A over B is just 3. Then if a trader go in and gives 3 token A plus a fee inside the pool, and he can get out 1 token B. Then the reserves in the pool, the token A's reserve will increase while the token B's reserve will decrease. Then token B will be more valuable in the pool. So the price directly moved from 3 to 3.01. So that's how the Uniswap pool's price are discovered. So we can see in this logic, the pool price in the Uniswap is actually mostly determined by the taker, because maker have no choice. They can only deposit the token into the pool with a ratio of the pool, so accept the pool's price. In such case, maker are compensated for the trading fees that takers are paying, the traders are paying. And because of this, because of the nature, takers usually will only try to swap with the pool when their revenue can cover the trading fee. So thus the price inside the pool is usually update slower than the other sex exchange price, which means there are arbitrage opportunity there if you are fast enough or if you can monitor multiple pools. So this is the first type of the DEX, the AMM model. And the second type is called the Perpetual DEX. And also we will look into the one of the famous Perpetual DEX, which is called GMX. It's currently the largest on-chain derivatives trading protocol based on TVL. So unless Uniswap is only support spot trading, and for each 2 tokens pair, it will create a new token pool to do the trade and to do the price discovery. On the GMX model, it supports on-chain both spot and perpetual tradings. And instead of creating a liquidity pool for each 2 token pairs, it actually creates a huge GLP pool containing all the tokens that is supposed to trade. And their price discovery is not through a constant product formula. Instead, it's using the oracle price, which means it will aggregate the outside the big exchange price and other DEX price to form an index price and refer to that. So also this is a high level of how the GMX models are working. As LP, you can choose to provide one or many tokens that the pool already have to support to be a LP inside the pool. So the the tokens weight in the pool will be predetermined. If the current weight of the token is less than the target weight, then if you provide this token into the pool, you'll be given a higher LP share, and vice versa. If the token of the pool is higher than the expected, then you provide this token will give you a lower share. So that's how the GLP token pool to maintain roughly the same ratio as the target ratio. And when the LP join the GLP pool, he will given a GLP token as a proof that he hold a share of the GLP pool. Then the trader coming, also they can trade against the pool directly. They can use some spots to just swap the target token they want inside the pool with the oracle price, and they can also use their collateral as they can also use their token as reserve as collateral and trade against the reserve inside the pool to open the perpetual contract, and the PIL is settled by the reserves. Yeah, the GMX model is not fully on chain because it still rely on the oracle price and the order keeper and portfolio keeper, which support the whole infrastructure. And and because in this model, traders can open perpetual position. So in order to make the perpetual price in the long run converge to the spot price, there are also funding fee there to be charged for either direction of the trader. And since nowadays this GMX model has already been forked to many other protocols or exchanges, there are a lot of different DEX, perpetual DEX on chain now, and every exchange have different like liquidity or price, and also like the funding fee. Therefore, there are funding fee arbitrage opportunities there as well in this kind of the model. Then the last but not least is the PMM and aggregator model. PMM stands for private market maker. They are they are actually coding through the technology called request for code. So it's also quite simple. The private market maker didn't rely on any on-chain model themselves, but they have their own liquidity and positions, maybe off-chain, maybe on-chain, but it's private, so no one else know. Then the user will go to the aggregator, and the aggregator will send the request to different private market makers. Let's say I'm the user, I want to sell like 100 ETH. Then the aggregator will go to different PMM to ask the PMM to give a quote. and it will pick the best quote from the PMMs and give it to the user. And the user have the right to accept or reject the code. And if he accept the code, then the aggregator will help execute all the transaction and settlement on chain. If the user reject, then the user can start to request for the new codes if the price is not what he want. So this is how the PMM are working. And if we compare the difference between AMM and PMM, first, the same thing is that AMM have a wide range of trading pairs, while the PMM, because the behind market maker need to hold the position themselves, so they may not support all kind of the tokens. and and second, usually AMM has the higher liquidity because it is aggregation of all different kind of the LP providers, while for PMM, most likely is their own like funds to create the liquidity. So it's not that high liquidity compared to the AMM pool, especially for the large tokens or major tokens. Third is that in AMM model, because the price are discovered by the curve. So when you swap a large amount of the token, the price may have slippage there. While on PMM model, because every price the PMM offer is a firm code, so there are no slippage, which means you see the codes, the amount you can exactly get if you accept the trades. And last is that the AMM protocol will charge the fee, which will make the beta spread widen compared to the PMM model, since PMM are usually like refer to the centralized exchange price, which have a higher liquidity and have a and don't need to pay the fee. So they have a smaller beta spread, which will usually offer the user a better price. And the aggregator is there actually to aggregate both price from AMM and PMM to find the best solution for the user. So one of the famous aggregator is 1inch. Here's like example of how 1inch aggregating swaps. So let's say I'm the user and I request to sell some Bitcoin to USDT. So as I send this request to the aggregator will send will send my request to different PMM and also find the price in different AMM protocols pools. So we see here he separate the whole transaction into several paths. The first one go to the swap BTC to ETH first within some AMM protocols, then swap to DAI with a PMM, then swap back to USDT with Curve, which is also an AMM protocol. Then finally to give me the USDT I want. The second pass you send to USDC, then USDT. The third pass is directly sent to swap to USDT. The reason why it splits so much is because I put a relatively large order, so not maybe a single place cannot take such a large size of order, or the price will be quite worse. So that's the value of the aggregator to find the the optimal solution for me. And yeah, this is a model of a PMM and aggregators, centralized exchange, DEX model. Okay, now since we have go through different kind of the DEX models, as a quant trader, what we can do to make profit. In TradFi or traditional finance, most of the quants are going to high frequency trading strategies or alpha driven strategy to compete for the revenue, because it's well developed for the TradFi. But on DeFi, because it's still on early stage and there are still inefficiency of price and liquidity, so there are still many arbitrage opportunity exist. For example, there are, as we mentioned, there are funding rate arbitrage between the Perp DEX. There are also like sex DEX arbitrage between the AMM model and the centralized exchange because of the nature of the AMM. And there are also like DEX, which is cross-protocol arbitrage, because some protocol liquidity is worse and the price update is slow. And also there are even cross-chain arbitrage nowadays because of the update frequency different for different chains. For Ethereum mainnet, it's about 12 seconds. For other layer 2, can be only several seconds or several milliseconds. So there are also arbitrage opportunity there if you are fast enough. So these are the definitely simplest thing as a quant trader can do on the DEX. The second category is called yield farming. So the original idea of yield farming is that the user put their funds into a protocol to join the protocol's event or financial or take the protocol's financial service. Then the protocol will give them their native token as reward. So basically sounds like you deposit your token in the protocol give you the reward. So that is called yield farming. But nowadays the definition of yield farming can be quite wide. So for example, as a LP in the Uniswap liquidity pool, it's kind of the yield farming because you deposit your token in the LP pool and get a trading fee as reward. And also there are like airdrop hunters. When the new project launch, high chance they will airdrop their own tokens to the early users. So if you like watch it closely, you can find this ready to launch protocol and join as an early user to get the airdrop. So that's all kind of the yield farming. As a quant trader, if you look closely, there are definitely opportunity and juicy return there to hunt for airdrops. And last but not least, the MEV, which is the maximum extractable value. So when we are trading on Ethereum or EVM environment, MEV is a thing we cannot avoid or we must face. What is MEV? First, we need to agree that the order of the transaction in the block do have value on Ethereum. So for example, if I want to do a swap, let's say I want to sell 1,000 ETH on Ethereum because I find the arbitrage opportunity on maybe a Binance. So I send this order to the builder. But if I'm on the top of the block, then definitely I will get what I want and the price I see in the pool, and then I can finish my arbitrage. But if if I'm not in the top of the block, which means some other searcher or some other trader may find the same opportunity as me. So they do the trade first. Then because they move the pool's price, I cannot get the price I want. So my transaction will fail. So that's why the order in the in the block the transaction order in the block do have value. Uh, Another example is that when same thing when I try to swap 1,000 ETH maybe to USDT on some AMM protocol, then if other searchers find my trade before it actually proof on chain, he do a in front trade with same direction with me, then I will get the worst price and move the push price to even worse price. Then right after my trade, the arbitrager in front of me can just swap the token back with a better price. So this kind of the MEV is called sandwich, which is quite famous on Ethereum as well. So actually, yeah, to do the quant strategy on Ethereum, MEV is the thing you must face. And the order of the transaction is not determined by first come, first serve. And actually, it is determined by how much bribe you pay to the builder. So the higher bribe value you pay to the builder usually put your trade in front. So that's how the Ethereum's ecosystem looks like now. In order to make sure you are in front of the block, as a quant trader, you need to make sure that your strategy is competitive enough and it can generate enough profit to compete with other searcher and arbitrageurs. So yeah, these are the high level of how the quant strategies looks like on current DeFi ecosystem. And of course, I cannot go too detail or deep uh, in this workshop. But yeah, guess what? As Tokka Lab, we are doing all kind of the strategies as I mentioned above. So yeah, if you're interested, welcome to join Tokka as an intern or full time. We can explore the DEX world together. And okay, that's close. That's actually close to the end of my presentation. So I would like to share some of the useful tools if you want to explore DEX or DeFi yourselves. Of course, First is the Ether which is used to read block and smart contracts. And second is called the Dune dashboard, which can help you find the necessary data you need. And there are already like well-established dashboard for you to refer to look into the DeFi data. And last is the DeFi Llama, which is the useful tool for you to search for different chains and protocols, their basic info, the TBL there. So yeah, hope that will be useful for you. And thanks. That's all of my today's presentation. Any questions or anything you want to discuss?
Hey guys, if you have any questions, please send them in the group chat. So Kenneth just asked, could you share some tech stacks in your quant trading
Oh, you mean the tech requirement?
systems? Yeah, could you share some tech stacks in your quant trading systems?
Uh, yeah, sure. So in order to be a like quant trader on DEX, of course, you first need to be familiar with the contracts. So basically nowadays most of them are Solidity. So better to get familiar with Solidity and try to read some contract yourself and try to deploy some simple one yourselves. That will definitely help you understand more about how DEX are working. And beside that, of course, there are also trading infrastructure needed to connect to different protocols and also exchanges. So uh, for exchange, there are like the API or SDK, or there are all kind of the method to connect. But I think that is more for a tech role to help you. As a quant, what you need to look at is actually how the price and how the logic are behind different kind of the exchange and protocols. Hope that answers your question.
Sherming asked, how do quant traders identify and capitalize on arbitrage opportunities across various decentralized exchanges?
Yeah, that's also a good question. So yeah, as I mentioned here, let's say we want to do an arbitrage between the Uniswap or maybe a centralized exchange, let's say Binance. So first I can get the Binance price update through Binance API in a very high frequency way, right? So I can get the order book from the Binance. Then on chain instead, because if I arbitrage between Ethereum, mainnet and Binance, then the price update is every 12 seconds. So within the 12 seconds, I can see the liquidity current inside the pool, right? I can know the current pool price, and I can know if I being at the top of the next block, what's the price I can get and what's the volume I can get. So I can quickly check the cross of the order book and this liquidity pool to calculate whether there are spread there. So if there are do have space there and can cover all the trading fees and cost and also the exchange fee, then definitely we can do the arbitrage, right? So that's a simple example of how do we find the arbitrage opportunity between the MM model and the centralized exchange. Yeah, hope that answers your question.
Great, thank you so much. Are there any more questions? Please send them in the group chat. Okay, Max asked, is traditional stat art used much in the DeFi trading space? And if so, have they been effective?
Pardon?
So, I'm not very sure what stat art means, but maybe you'll understand that. In,
Let me check the
yeah, in the group chat.
traditional stats.
statistical arbitrage?
Use machine diffusion space. Yeah. Yeah, okay. It's a good question. So as I mentioned, in TradFi, because all the system and data are well established, so basically every trader are at the same stage. They have the same thing. When they are doing the arbitrage, they need to find the strong enough alpha, or they need to be fast enough to be high frequency in order to catch the opportunities. But on DeFi nowadays, I would say actually it doesn't worth much to do stats arbitrage, because there are already like very obvious arbitrage there. So statistic arbitrage, I would say statistic arbitrage is not 100% correct, right? And it requires a strong ability to find the alpha. But I do think if you are look at long term, uh, or looking into the future, definitely this kind of strategies will be useful in DEX or in DeFi space now. But nowadays, we are not doing too much of a static arbitrage. Instead, all our strategies, not all, maybe most of our strategy are data neutral, which means we didn't take any market risk. We just be market neutral and take profit. That's our arbitrage strategy. Hope that answers your question.
So Kenneth asked, does this mean that we are executing instructions in tranches of 12 seconds? I think it's related to what he asked just now about the tech stacks in quant trading systems.
It means that we are executing instructions in tranches. Yeah. So if we are trading on the Ethereum mainnet nowadays, every block will be built with 12 seconds in interval. So which means when we send the request or send the swap to some protocol or some counterparty on chain, then the trade can only be confirmed after 12 seconds with a branch of the different other transactions. So that's things we need to face in current DEX. But if you are looking for like a more high frequency strategy or want a less interval of the transaction update, you can go to some layer 2 or even non-EVM blockchain to find more opportunities. Yeah.
Okay, Isa asked, what do you think is the biggest difference between traditional finance quantitative and DeFi quant?
Yeah. Yeah, it's also a good question. So for myself, I actually go from the I have 3 years work experience in TradFi myself. So at that time, I'm the alpha researcher. So I'm doing the index futures and equities. So my personal experience that in TradFi is more about like alpha driven and alpha finding. So you will need to search for different alphas, look into alternative data, and training the model or even using the machine learning technology to build the signal yourself. I would say that kind of experience do help, definitely will be helpful in DeFi. But nowadays, DeFi is more about understand different protocols, because the protocols themselves are also developing and improving their model or improving their contract. So the most important thing is that is actually you can catch up all the changes in DeFi. So in DeFi, I would say every 1 month will be different. So there are quite a lot of things happening. So if you only look at the token, I mean the token price themselves, it may not be that useful instead of looking at the whole DeFi ecosystem. Yeah, hope that answers your question.
Kenneth asked, how much do you have to pay for the high frequency APIs?
Do you have like exact target API? What API you mentioned?
Maybe Kenneth, you can write some in the chat while we answer the other questions. He also asked, does more of the arbitrage come from CX DEX or DEX DEX, etc.?
Okay, so yeah, I would say sex DEX arbitrage are yeah. First, let me explain the DEX arbitrage. If you are doing a DEX arbitrage, means both of your two legs are on chain, so which means you can be a trace. So we'll consider it as like the arbitrator, the searcher. So the volume can and the transactional trade can be traceable by anyone else on chain if they find carefully. But if you are doing the sex DEX arbitrage, your DEX leg is on chain so everyone can see, but your sex leg is off chain, so it's not open and clear. So I would say it's hard to evaluate how much of the weight are doing sex DEX up or how much of weight are doing DEX up. But overall, I believe the sex DEX up do have more volumes because the sex side still currently have the more liquidity there.
Okay, thank you. Kenneth just clarified his question. So he meant how much do you have to pay for the high frequency APIs with reference to Binance or
Mm.
Coinbase or OKX, since they are the larger exchanges with more liquidity?
Yeah, I think they are public the public price you can actually search online and find yourself. But to be honest, as a company, we'll have like some discount maybe. But to be honest, I don't really know. Well, it's our MO handling that. Yeah.
Okay. Max asked, speaking of ML approaches, do you think that GPT type models have the potential to perform sentiment analysis and the like to generate alpha?
Yeah. That's also a good question. So actually, I do think the current crypto world or the DeFi is sentiment driven, definitely. So you will see that there are a lot of like sentiment on especially Twitter or some other social media net platform. When some QI push something, then the token price will be driven up or driven down. So yeah, I think there do have some space for the GPT model if you can process an NLP and find the sentiment of certain tokens. But the barrier is still like if you are fast enough, because this kind of the sentiment usually not last for a long time. Instead, you need to be the early stage to catch the trend, and it's also like not 100% safe. So you will need to take some risk because some of the token created may be the pool may be rugged or there may be some I would say some people create some token to which allow you to buy but don't allow you to sell. That also happens. So you need to be careful if you're doing this kind of the strategy. Yeah.
All right, I think we have time for one last question. So Kenneth asked, could you name some good resources or textbooks to start learning quant trading and working on the technical stacks of quant trading for either traditional finance or DeFi?
Okay. Uh yeah. How do I start? Actually, I think to understand DeFi, there are well-written blogs online you can find easily, and also even on Twitter there are a lot of KOI who sharing the very useful background of the different protocols, and that would be useful for you to trade on DeFi. On TradFi, yeah, I think nowadays of course, there are a lot of good textbooks, but also nowadays most of the traffic are going to machine learning and the high frequency world. Uh, yeah, maybe I can give you some. I will send some of the textbooks later in the group. Yeah.
All right, thank you. Sorry, Michelle asked one, so this will be the last question. Michelle's from the pure business or basically traditional finance, sales, and trading background, and she's wondering if you know any junior level who have no technology or coding background who is now working in your industry or firm. I think she's wondering whether someone who doesn't have a technology or coding background can work in your industry or in your firm. And she's wondering what position they're working in.
Yeah. So actually, I do know someone who are actually from not from any financial background or tech background, but they are just very interested in the crypto world. So they joined the crypto world quite early and follow all kind of the protocols like a society. So they joined actually he joined the society of different protocols and can pick up with the scenes quite quickly and know what's going on. And like I mentioned, hunt for airdrop is also a successful strategies nowadays. So I do think uh, if you are not tech or finance background, but if you have the enthusiasm, you are enthusiastic enough for the crypto and for the DeFi society, then there's do have some opportunity there for you to join. And also I do know some good KOLs who are actually just YouTubers, but they shares their crypto experience, and now they are joining our market team as well. Yeah.
All right. Um, do you have perhaps a contact email for us to ask further questions? Because Kenneth, one of the students, he really wants to get the resources that you were talking about earlier.
Yeah, sure. I will leave my company email here.
Okay, maybe you can leave it in the Zoom group chat. That'd be amazing.
Oh, sorry. I should leave my, let me leave another one.
Yep, no worries. This is the last session, so we can extend a little bit. All right, so while I wait for you to write in your email, I'll just wrap up. So, thank you so much, Mr. Chung, for your detailed insights. For all participants who are still here, please help us scan this QR code to provide any feedback for our workshops so that we can continue to provide valuable ones for you in the future. Thank you, everyone, and thank you, Mr. Chung. Thank you so much for your valued participation in our past 2 days of workshops. We will be having our final day of workshops tomorrow at NUS Com 1 at level 212 from 10 a.m. to 4:45 p.m. and we look forward to seeing you there. Thank you so much. And Mr. Chung has just sent his the Tokka Labs email to in the group chat. So Kenneth or anyone interested, if you'd like to take this down, now would be a great time. But other than that, thank you everyone, and this will be the end of our session.
Thank you.
Thank you, Mr. Chung.